Private equity investors don't look for perfect companies, they look for fixable companies. They ask three questions. Is this a good business? Is this a good deal? Can we make it better? If the answer to all three is yes, then you have a private equity quality opportunity, if I may. Private equity firms evaluate companies through four lenses. Lens one, the market. Now, before the company, you evaluate the neighborhood. You look at market size, growth rate, fragmentation, competitive intensity, pricing power, customer behavior, regulatory environment. A great company in a bad market is a bad deal. A good company in a great market is a great deal. Lens two, the business model. Now, this is the engine of the company. Here you evaluate revenue quality, I beg your pardon, recurring or non-recurring revenue, customer concentration, margin profile, scalability, pricing strategy, cost structure, as well as cash conversion. Private equity investors love recurring revenue, high margins, low churn, strong pricing power, predictable cash flow. Lens 3, the financials. Private equity investors don't fall in love with revenue. Private equity investors fall in love with cash flow. Here you analyze EBITDA quality, working capital needs, capex requirement, debt capacity, seasonality, cash conversion cycle, historical consistency. The question here is simple. Does this business produce real durable cash? Lens 4, the people and operations. Now, this is the most underrated lens because you evaluate leadership quality, depth of management, culture systems, processes, talent density, operational discipline. A great business with weak leadership is a private equity opportunity. A weak business with great leadership is a turnaround. A weak business with weak leadership is a pass. Now, here is the exact framework private equity firms use. Step 1, understand the business in one sentence. If you cannot explain it in one sentence simply, you don't understand it. Step 2, identify the value drivers. Now, every business has 3 to 5 levers that matter most. Talk about pricing, sales efficiency, customer retention, gross margin, utilization, capacity. Private equity investors focus on levers that move the needle. Step 3, identify the risk. Now, every deal has risk. Your job is to identify it, quantify it, price it, and mitigate it. Private equity investors don't avoid risk, they manage it. Step 4, build the investment thesis, as I keep saying. A thesis answers why this company, why now, why us, what will we do differently. A deal without a thesis is gambling. Step 5, build the value creation plan. Now, this is the blueprint for improvement because it includes leadership upgrades, pricing optimization, operational improvement, digital transformation, mergers and acquisition, new markets. Private equity investors buy companies for what they can become. Like I keep saying. Now, here are the biggest red flags private equity investors watch for: declining margins, customer concentration, inconsistent financials, high churn, weak leadership, no pricing power, high capital expenditure, no competitive advantage, unclear value drivers. One red flag is manageable, but 5 red flags is a pass. And of course, the green flags. That is the signals private equity investors love. They love recurring revenue, strong margins, low churn, high customer lifetime value, strong leadership, clear competitive advantage, pricing power, predictable cash flow, simple operations. These are the companies private equity firms fight over. Now, to evaluate a company like a private equity investor, you need a system that looks at the market, the business model, the financials, the people, the risk, the value creation potential. If you can evaluate companies through these lenses, You will see opportunities others always miss.